Markets continue to crash, with the S&P 500 falling 12% on the day, making it a loss of 29.7% from the peak about a month ago. Overall, the past year, your return would have been almost negative 16%, which isn't a good look for the market going forward. With all the uncertainty in the market, it's hard to say where things will continue to grow. Will the stocks continue to drop? It seems like there is a possibility that that will happen. In terms of sector impact, the biggest fall in the day was the real estate sector. The not so big loser was consumer staples, only falling 7% on the day. The Dow Jones fell even further, falling 13% on the day, making it a loss of 31.7% from the peak. In total, over the past year, the Dow Jones is down over 22%. The Nasdaq hasn't fared much better. It is down 12.3% on the day, making a 29.7% loss from its previous high. Overall, over the past year, the Nasdaq is down 10.5%. In Canadian markets, the S&P/TSX fell 9.9% on the day, making it a total loss of 31.2% from the previous high. And over the past year, it's fallen about 24%. In terms of sectors, the S&P/TSX Capped Energy Index was the biggest falling sector, falling over 18%. Next was a consumer discretionary sector, falling about 15%. In terms of a winner, surprisingly, the S&P/TSX Cap Material Index managed to go up 2.6%, which I thought was pretty interesting to see a sector actually go up when the loss is almost 10% on the day. In Europe, the FTSE fell 4% on the day, making it a 5-day loss of 14.7%. In Asia, the Nikkei fell 2.46%, making it a 5-day loss of over 11%. Oil continues to tumble, falling 9.3% on the day for WTI and 11.8% on the day for Brent. As you can see, that differential is barely a dollar, which is pretty crazy when you consider that it's usually around $6 mark. Overall, the price war between Saudi Arabia and the economic conditions around the world continue to drive oil down. If you thought gold would be a safe place right now, gold doesn't seem to be doing much better as it fell 73 basis points on the day. And looking at that 5-day change, it's down 9.3%, down to that 1500 mark. So if you're expecting gold to be a safe haven in this crisis, it doesn't really seem to be doing that well. In terms of yields, they seem to be stabilizing as short-term yields seem to be going down. Just looking at the Canadian Treasury yield curve and the US Treasury yield curve, it's actually pretty interesting to see that they are leveling out and they're not inverted pretty much anymore. So overall, I guess that is some good news. In the currency markets, the Japanese yen continues to perform strongly. I think a lot of that has to do with interest rates as they haven't cut interest rates while many places like Canada and the US have. Canada was a big loser on the day, but that's understandable when you consider the changes in oil prices continue to fall. The Australian dollar also had a struggle day, as well as the British pound. COVID-19 continues to dominate headlines, with total cases reaching over 180,000 and deaths peaking over 7,100. Overall, Europe is really struggling as Italy continues to add a lot of cases, over 3,000 on the day, as well as places like Spain, Germany, and France all adding over 1,000. It also continues to expand in North America, with the US adding over 500 cases. Overall, it's not looking too great, as a lot of people are bunkering in and hoping that everything will calm down and that the spread will be limited overall. In total, there's about over 11,000 new cases and about 600 new deaths. This has led to governments intervening, with the Canadian government closing the borders to non-citizens and non-residents and restricting international travel to limited airports. France has also closed down non-essential stores. Spain is telling people that they should just stay home and not to leave home unless they're going to work or to get groceries. US has also introduced more travel restrictions to try and limit the spread. It has also led companies to take an impact as well, with Tim's and Starbucks shutting down their in-store seating so that less viruses transmits. Also, you have Aritzia closing down their stores, as well as Shaw Communications, Apple, Under Armour, and Nike. Overall, it seems like there's a lot of places trying to make sure that people don't meet as much and that it doesn't spread as much as maybe it possibly could if these measures weren't taken. The Federal Reserve stunned markets by lowering interest rates in an emergency rate cut. They lowered interest rates by 1% down to that 0% to 25 basis points mark. Not only are they lowering rates, but they're actually introducing a new quantitative easing program as they plan to purchase 700 billion worth of assets. They plan to purchase a total of 500 billion in treasuries and 200 billion of agency mortgage-backed securities, and they plan to spend at least 200 billion over the coming months. They're also cutting the reserve requirements ratios for banks down to 0%. Essentially, that means certain money that banks have to keep to try and keep stable, and in crisis situations, they're letting them use that money to lend out to other people. Overall, there are some questions on whether this was appropriate and that it will help out, because some might suggest that it might increase investor panic as a signal from the Fed that things are not doing too well. Also, others suggest that it could stabilize the markets as the Fed is showing that they are planning on intervening. Overall, though, looking at markets performance today, they took a real hit, and it doesn't seem like people reacted too positively to this news overall. It's really interesting to try and think about whether this will actually have a positive impact on the economy. Overall, it'll help banks lend out money to businesses that are struggling and have been hit hard, that still have to pay employees, try and pay their debt off, and it'll allow businesses some room in that area. But overall, if they're not making money, especially if they're smaller businesses, they really might not be able to necessarily survive that long, and even taking on this additional debt may be detrimental to them in the long term, as they may not be able to sustain the additional level of debt that they might have to take on, even with this lower rates. Also, it's hard to see a lot of spending going on as many people are confined to their homes. So many people probably won't take a loan to start a business, go and buy a boat or something. So it really doesn't, can't imagine that this will do that well in the economy we have right now. In terms of forecasting how GDP is going to go, Goldman Sachs have actually expecting US GDP to grow by 0% in Q1 and fall by 5% in Q2. And they also warn that the S&P 500 may not bottom out until it hits that 2000 mark, which would be a significant drop still from where we are now, which would be a total of 41% drop since the high in February. Overall, though, it's hard to say where the economy is headed and how much impact everything will go on. But I'd just say watch out for those debt levels as they might start increasing, even though we are at a pretty high debt level already. 8 U.S. banks have also announced that they are planning on stopping their share buyback programs as they want to use that bank to help lend out to other banks and really just try and save up as much cash as they need in this situation. The Bank of Canada has also announced new measures to try and help support the markets. After they did an emergency interest rate cut in Canada as well, the last Friday, where they cut interest rates by 50 basis points, they're also planning on expanding the eligible collateral for their repo markets and really trying to help businesses being able to get money that they need to try and sustain themselves overall. North America isn't the only place cutting their interest rates, as the Bank of Korea has now slashed their interest rates to the lowest level ever. So they're now at 75 basis points as they cut their interest rates by 50 basis points. Overall, they're expecting lower economic growth, and this is part of the reason to try and help the economy recover. Overall, the bank previously expected growth to grow by 2.1%, but that doesn't seem likely. Goldman Sachs is expecting that expansion will only be at 1%. Overall, it's hard to say exactly how South Korea is going to do, as they seem to be doing pretty well if you compare it to other places in Europe, as the virus doesn't seem to be spreading as significantly there. They're also looking to do increase their budgets. As you can see here, South Korea's government is worried about long-lasting damage from the virus outbreak and is seeking a swift parliamentary approval for 9.5 billion extra budget. Overall, that just adds to a lot of places that are trying to stimulate their economy in this area, as the Reserve Bank of New Zealand also recently announced an interest rate cut by 75 basis points and is also planning to ready for asset purchase. The Bank of Japan is also expanding their purchase of stocks, doubling actually their ETF repurchase, which is kind of interesting, as well as bonds and other market interests. They're also planning on providing 0% interest rate 1 year loans to places that really need them. The European Central Bank has also taken action. While they haven't lowered interest rates yet, they could possibly do that in the future. I could see happening. But right now, what they've done is they've freed up a total of 112 billion of bank capital to help maintain the flow of credits um, that is caused by the virus going on. Overall, it seems like a lot of places are really trying to help banks get money there out to businesses and people that really need it and are in situations that could really have a turn for the worse if they don't get those loans. I'm not 100% sold on a lot of these initiatives, how much impact they'll actually have, especially when you consider the scenario we're having. And even in terms of interest rates, looking at the 10-year yields and how interest rates have fallen, part of it kind of feels reactionary, especially when you consider that the Federal Reserve's target rate is now the first time it's been below the government treasury yields. I thought this article was pretty interesting, just kind of giving some perspective on the actual numbers of what governments are pledging in budget support to combat it. As in the Middle East, Saudi Arabia, the United Arab Emirates, and Egypt all pledged to collectively introduce 47 billion worth of stimulus to try and help, as well as many other places are also doing the same. In total, over more than 187 billion in budget surplus support has been announced. Also, you have a total of 12 billion in virus aid coming from the World Bank, and the IMF is planning on making 50 billion available to countries that really need it. 10 billion of that is going to be zero interest rate to try and really help those uh, more poor nations who might not be able to get the line of credit, especially at the interest rates that they would need to be able to try and pay it off. The IMF is also announced that they are ready to mobilize $1 trillion in lending capacity around the world to places that really need it and that are heavily impacted by it. It just seems, though, to me that there has been a lot of government spending. You haven't seen too much, especially in the US, of governments actually being able to manage the budget, not take on additional debt. And this really comes in where people were saying before that you really shouldn't keep taking on all this debt while the economy is going well, because it gives you less room in a crisis situation to expand that debt. Because how long will the governments be able to continue to push out this massive amounts of cash? Overall, it's hard to say, but I guess we'll find out in the future. Due to economic numbers coming out after the fact, we haven't really seen much of the impact the virus is going to have on the economic numbers. But today, the New York Federal Reserve's monthly manufacturing survey came out and it didn't look great. Headline Business Condition Index fell 34 points down to negative 21.5, which is the lowest since 2009. What was expected was 4.9, so that's pretty significant difference overall. New order index fell 9 to not negative 9.3, and shipments index fell to negative 1.7. Overall, though, that was the largest decline on record and really isn't a good look going forward. But hopefully everything turns around quickly and isn't affect things for a long time. In company news, Canadian energy sector just can't catch a break, with oil continuing to slide down to even lower levels. The energy sector in Canada has been really struggling, with many companies announcing lower capital spending. Crescent Point Energy is the next company to announce as well. They plan to cut their capital spending by about 35%. In total, their capital spending is now going to be around that 700 to 800 million mark, down from 1.1 to 1.2 billion. They're also planning on reducing their dividends basically next to nothing to try and save on that cash. In the terms of production, they lowered their production estimates to 130,000 to 134,000, down from 140,000 to 144,000. Overall, Canadia's energy market continues to struggle. I thought this news was kind of interesting. It's a little different than most of the stuff that's going on, but still could be important going forward. So France has now fined Apple 1.2 billion for what they call anti-competitive acts. What they're claiming is that Apple is making deals to try and keep prices high. As it says here, the agency said Apple and top resellers agreed to align prices with Apple's own pricing for its iPads and some other products. The deals did not concern iPhones. Overall, this is just more in France's aggression against US tech companies as they earlier last year were going against Facebook and companies like that. It seems like France is strangely targeting them. Hard to say. Maybe they have a case here, but just seems strange that it's France is the one that is finding Apple.